Leverage plays a significant role in business finance, helping companies magnify their potential returns. Two key types of leverage are operating leverage and financial leverage. While both leverage concepts involve the use of fixed costs to amplify profits, they differ in how they affect a company's operations, risk profile, and financial structure. Understanding the differences between operating leverage and financial leverage is crucial for managers, investors, and analysts to make informed decisions about capital structure and profitability. In this video, we explore the top 10 differences between operating leverage and financial leverage, and how they impact a company's financial health and performance. 1. Definition and focus. Operating leverage refers to the use of fixed operational costs to magnify the impact of sales on a company's profits. Companies with high operating leverage have a large proportion of fixed costs in their cost structure, meaning that changes in sales will have a greater effect on their profitability. On the other hand, financial leverage pertains to the use of borrowed capital, debt, to increase the potential return on equity. The higher the proportion of debt in a company's capital structure, the more financially leveraged it is. 2. Source of leverage. The source of leverage differs between the two types. Operating leverage is driven by the company's cost structure, specifically the proportion of fixed costs to variable costs. In contrast, financial leverage is derived from a company's capital structure, specifically the amount of debt it has relative to equity. A company with high operating leverage will have more fixed costs, such as rent and salaries, while a company with high financial leverage will rely more on loans and other forms of debt financing. 3. Impact on profitability. Both types of leverage affect profitability, but in different ways. Operating leverage has a direct impact on a company's operating profits, EBIT. When sales increase, companies with high operating leverage can see a significant rise in profits because their fixed costs remain unchanged. Conversely, when sales fall, profits drop rapidly. Financial leverage, on the other hand, influences the net income by increasing interest expenses. As the debt level increases, interest payments eat into profits, potentially reducing the overall return for equity holders. 4. Risk exposure. Both operating and financial leverage increase a company's risk, but in different ways. Operating leverage increases business risk by amplifying the impact of sales fluctuations on profits. A company with high operating leverage faces higher risk if sales fall because fixed costs remain constant. Financial leverage, on the other hand, increases financial risk. A company with high financial leverage faces the risk of being unable to meet debt obligations, especially in periods of low profitability, which could result in financial distress. 5. Effect on break-even point. The break-even point is the level of sales at which a company's total revenue equals its total costs, resulting in no profit or loss. A company with high operating leverage has a higher break-even point, meaning it must generate higher sales to cover its fixed costs. This is because fixed costs do not change with sales volume. In contrast, a company with high financial leverage may not directly affect the break-even point in terms of sales, but the break-even point for covering debt interest and principal payments increases because of the added financial obligations. 6. Flexibility in cost management. Companies with operating leverage have less flexibility in managing their fixed costs. Since fixed costs do not fluctuate with sales, the company cannot reduce them easily, even in periods of low sales. This lack of flexibility makes high operating leverage riskier during economic downturns. Financial leverage, however, offers more flexibility. Companies can adjust their debt levels over time by taking on more debt or paying off existing loans, thus allowing them to manage their financial obligations more strategically. 7. Impact on cash flow. Operating leverage impacts cash flow by magnifying the effect of sales on operational cash flow. Since fixed costs remain constant regardless of sales volume, any increase in sales results in a significant boost to cash flow, while a decrease in sales can cause a substantial reduction in cash flow. Financial leverage, on the other hand, affects cash flow through interest payments. High levels of debt increase interest expenses, which must be paid out of operating cash flow, thereby reducing available cash for other purposes like reinvestment or dividend payments. 8. Investor perspective. Investors view operating leverage as a measure of business efficiency. A company with high operating leverage is generally seen as having the potential to generate higher profits when sales rise, though it also carries the risk of large losses as sales decline. Investors who are confident in the company's ability to grow sales may view high operating leverage favorably. Financial leverage, however, is typically seen as a risk-reward trade-off. Investors might appreciate the potential for higher returns generated through debt financing, but they also need to consider the risk that high levels of debt can create financial strain, especially in periods of low profitability. 9. Effect on financial statements. Operating leverage affects the income statement by influencing the company's operating income. Since fixed costs remain the same regardless of sales, fluctuations in sales directly impact the operating profit. Financial leverage, on the other hand, affects both the income statement and the balance sheet. High financial leverage leads to increased interest expenses on the income statement and higher liabilities on the balance sheet. This can affect profitability ratios and financial ratios such as debt-to-equity ratio and interest coverage ratio. 10. Use in strategic decision-making. Companies use operating leverage strategically to increase profitability as sales grow. A business with high operating leverage can benefit from economies of scale, where the average cost per unit decreases as production increases. However, companies must manage operating leverage carefully to avoid excessive risk during economic downturns. Financial leverage is used as a strategy to optimize the capital structure. By using debt to finance expansion or operations, companies can increase returns for equity holders, but excessive financial leverage can lead to higher interest costs and financial strain, particularly during economic slowdowns. Both operating leverage and financial leverage play crucial roles in determining a company's risk and potential profitability. While operating leverage is focused on a company's cost structure and how sales impact profits, financial leverage is centered around the use of debt to enhance returns. Each type of leverage has its own advantages and disadvantages, and the key to effective financial management is understanding how these two levers can be optimized to suit a company's strategic goals. Companies must carefully consider the trade-offs involved in both types of leverage, balancing the potential for higher profits with the risks of increased exposure to financial and business volatility.